What's up, everybody? This is Investing Sensei here to bring you another video. This one's going to be about options. So if you are interested in a way of generating extra income while you want to buy shares, this is definitely a great video for you. Yeah, I'm going to be showing you guys from beginners to, absolutely nothing, knowing nothing of options of cash secured put to completely understanding what a cash secured put is, what are the possible outcomes at the end after you sell one. So definitely stick around because we are going to be doing some great, I'm going to be giving you guys some great information about it. So first thing is I will be using Robinhood to go through this GUI, tutorial information because I think Robinhood has one of the best user experience when it comes to options. It's easier to understand, so that's the main reason why I'm going to be using it. But the first thing that I do want to mention is in the options world is whenever you hear one contract controls 100 shares. So if you have 3 contracts, then that means you control 300 shares of that option. So just keep that in mind. First thing is, what is a cash secured put? So for us, selling a cash secured put option gives the buyer of the put option the right to sell you the shares of the contract at the predetermined price and time. If that did not make sense, don't worry. We will be diving into it. It'll make more sense once I do some examples. But basically what you're doing here is that you are almost selling insurance to the buyers of options, and you're saying, hey, I will buy those 100 shares. I have the money to buy the 100 shares of the stock if you pay me some insurance for you to do your gambling, which we'll dive into it. So if I do have Robinhood, I have Palantir here, where that's the stock we're going to be using it for the example. And let's say that you want to own more Palantir or whatever company that you want to own. And just in this example, we're using Palantir. Typically a cash secured put's a great way to be assigned more shares because you don't mind holding them for the long term, and that's an extra way to purchase those stocks at a given price. And they're also going to pay you some extra money, so you can technically lower your cost basis at that point. But the first thing we're going to do is go to trade Palantir options. This is the options chain. You will have to apply for it if you're a beginner. But first thing we're going to see here is you're going to see buy, sell, call, put. In our case, we're doing cash secured puts, meaning that we do have the money to buy 100 shares of the stock if it got assigned at the specific strike price. So that is what a cash secured put is. And if you didn't have the money to purchase the 100 shares, then that you would be looking at that as a naked put, meaning that you don't have the money, but you do have the margin available to sell puts. That naked puts are a little bit riskier, but I do them because they're pretty much a great way to make some extra income. If you do, I guess if you manage to trade, but they're a lot riskier. Cash secured puts, worst case scenario, you will get assigned 100 shares. You have the money to cover it and you are good to go. Naked puts are a little riskier, but that's not the topic for this video. But first thing is the way that I think of when you buy a call or buy a put, I think that as think of it as a casino. The people that go into the casino and they gamble, think of those as the buyers of the calls or the puts. Those are the people that typically go in, spend their money. The majority of the time they lose it. Think of the people that sell the calls or the puts. Think of those as the casino itself. So remember that in the casino, majority of the time the house always wins. In our case, we are going to be the casino because we are selling puts and selling calls. In our case, we're going to be selling puts this time because we are selling a cash secured put. So what does this mean in our case? So first thing I'm going to explain, you'll hear something called DTE, that's date to expiration. That's typically the date that the contracts expire. Typically, most of the options always expire on a Friday. The only ones that you could have expired every 3 or 2 days is SPY, but we're going to be looking at weekly options here. But I'm very close to the 18th of February, which is actually tomorrow. So we're going to jump over to the 25th, which is about a week away from here, from today. And so we're going to be using that as our DTE, so meaning that whatever contract we end up selling, it will expire on the 25th of February, and then you know, we will be out of that contract depending on the outcome. So the next thing we want to consider is our strike price. So let's say I want to own 100 shares of Palantir, or I don't mind owning or buying more shares of Palantir. Let's say I wouldn't mind buying it at $12, and you know, I would say I wouldn't mind buying 100 shares of Palantir. So you'll see Palantir is currently trading about $12.51, 52 cents. It's kind of fluctuating. So you know, I could buy them right now, but if I know Palantir might go down more, why not buy them at a specific price? And I can also get paid to purchase more shares. So first thing is we want to pick the strike price after we pick the expiration date. So what we chose is the 12 strike price, and the next thing after that we want to look at is the premium. So this is the premium. This is what they pay us as the insurance, that we will say, hey, for you to do your gambling and we'll buy the 100 shares at the strike price of $12, you have to pay us 42 cents, which really means $42, because remember, one contract is 100 shares, so you have to multiply the 42 cents times 100. So what does this mean here? That means that we need to have $12 times 100. That is $1,200 that we need to have available in our account to, in case our shares were, well, I guess not our shares, but the contract was to get exercised, we would have to buy Palantir at $12. If it keeps dipping, we're still gonna have to buy it at $12. It doesn't matter. Let's say that by February 25th it's trading at $11. We're still gonna have to buy it at $12, and we'll keep the premium. But that's how the buyers of the puts make the money from the difference, because technically they sell it to us at $12 and then they can buy it at $11, so they make the difference. That is how the buyers make money. But in our case, we make money because we want to sell it on companies we wouldn't mind getting assigned 100 shares, plus we keep the premium. But what this means is we need $1,200. But here I'm going to show you the possible, well, I guess let me show you the gains that we can make. So if I pull up the calculator, I'm going to show you the math real quick. So if we do 42 divided by 12, which is our strike price, we would make about 3% on this weekly option. And you know, there's 52 weeks in a year, so you could multiply that times that. But in our case, let's just stay conservative and say that we're selling you know, monthly, meaning that they wouldn't expire till March 25th or so. Actually, let me show you. Yeah, we could do that. You could just multiply it times 12, and we would get about 42% return on our money. Really, we would be collecting much more premium if we wanted to. Like if I went over here to March 25th, you would see that the premium would be way higher. So see, 69. So yeah, that's premium goes up the further you go out into expiration, because your money is held on there. But yeah, it's a great way to generate some extra income here, and that's one of the things. So what are the possible outcomes whenever you sell cash secured put? So in our case, let's say that we sold the put at a strike price of $12, and it expires the 25th of February, which is a week away from now, and we collected $42 in premium. You know, so that the possible outcomes here that could happen, the first one is that Palantir trades above $12. Let's say it closes on the 25th at $12.01 or $12.50. Anything above $12, it means that the contract expired worthless. So This means that that's going to happen is that we get to keep the full premium of $42, and we get to keep the $1,200 and for that week. So that is a pretty great outcome. A lot of people try to make sure that they get contracts that expire worthless because their aim is just to collect that premium, because you saw that it's about 3% per week that you could be generating in income if you pick the right strike prices. But that's the first possible outcome. The second possible outcome, let's say that Palantir is trading, let's say at $11.50, and we sold the 12, remember? So that means that it is way below our strike price. That means that we end up getting assigned 100 shares of Palantir at $12 because that is our strike price, and our money gets taken away to purchase those shares, and we get to keep the premium of $42. So that's the other outcome. It doesn't matter, as long as it's just below $12, we will get assigned the 100 shares at the given strike price we selected. So it's you know, to me, I personally like it because you get to select at what price you wouldn't mind getting assigned 100 shares. But the third possible outcome that could happen here, guys, is you could actually exit the contract early. So it's a buyback. So you could buy back your option. So let's say that in this example, we collected the $42, and it's a weekly. So it's on the 25th when it expires, let's say by the 22nd of February. So we're on the 17th today, but let's say on the 22nd, this contract, because Palantir started moving upwards, let's say I was trading like at $14, the premium of the contract is worth now, let's say for example, $12 or something, 0.12. So in that case, we could exit the position early and end up selling another cash secured put if we wanted to. But the way that this would work is that you would purchase the option, which is what you would do is you would go to buy put, and you would, that way you could actually exit the position. You'd have to select the correct strike price, correct expiration date, and correct correct expiration date and correct strike price. And then what you would do here is you would pay the difference. So in our case, we collected 42 cents, which is $42. You would subtract the amount that you have to pay to buy that option back, which in our case, let's say it's worth $12. You would actually end up keeping the difference. So you would make $30 and profit, and you would exit the position early, and you don't have to wait till the 25th of February. And that would give you the ability to actually place another one if you wanted to. In my case, I typically try to buy back my options about at 40 to 50, depending, 40 to 50 to 60% profit on the premium if I do have plenty of time left over before the expiration. Because remember, in the market it's very volatile, and you could actually go in the negative fairly quick. So I typically try to close those options fairly early if I can. So you know, it's there's no point in taking more risk in that. But the next possible outcome that could happen with selling a cash secured put is that you could actually end up rolling that contract. So in our example, we did the expiration of February 25th, and strike price of $12. We collected 42 cents or $42. What you could end up doing, let's say that you didn't want to get assigned at $12. Let's say you say, well, let me give it one more week, and hopefully we can move down to $11.50. It depends on your strategy, if you want to get assigned or if you don't, or you just want to get assigned at a lower strike price. In this case, let's say that we wanted to move down to $11.50. The way that you would do this is by a roll. So in this case, what you would do is you would pick a further expiration date. So let's say you would do March 4th or March 11th, whichever day that you want to, but a date that would give you that strike price that you want to roll down to, that would give you the difference. So in this case, you would just buy back the $12 option of 42 cents, whatever it's worth. You would pay that, and then you would need to select the right strike price that you want, and then select you would select the expiration date and the right strike price, and then you would pay the difference, because you would sell it. So typically in a roll, what you want to do is, let's say, we paid 42 cents to close this position, right? You would need to select either another strike price lower that would give you 42 cents or more, or you would have to go further out in the expiration that would give you 42 cents or more, so that you don't have to pay anything, if that makes any sense. That's typically what you want to do in a roll, is you want to pick the strike price or a further expiration date that you can kind of cover what you used to exit the position and re-enter it again. So that's kind of like the goal there. And then the final possible outcome from this put that could happen is that you could actually get assigned early. So remember, in our case, we have an expiration date of the 25th of February. This is gonna, typically most of the contracts will expire on the 25th. So that means if by that date, the stock is below or above the option, you could either get exercised or expires worthless. There are chances where you could just get exercised way earlier before the expiration date, so there is that possibility, just so you guys know. But yeah, I think this is all I have for you in this tutorial. Hopefully you guys learned something. Let me know if you guys do sell cash secured puts in the comment section, and don't forget to subscribe with that bell notification. Let me know what type of videos you guys would like to see about options, and then I'll be happy to make them. But I will see you guys in the next video. Take care, stay safe out there. Bye guys.